Good morning. Today is November 3rd, 2022. Just doing a little talking, little walking through what we're doing here today. Um, a lot of success with the broken wing butterfly strategy. Um, Market's been very jagged, so this strategy I found really is working very well in markets where the market is really kind of whipping around, but overall going down. So the beautiful part about the broken wing butterfly is that you have this nice flat curve, and as the market whips around and volatility whips around, you're still collecting theta. You're still making money every day, and it's gaining theta decay. The other great thing about the broken wing butterfly is that it's a relatively inexpensive investment. I mean, one contract here, I'm putting on $1,500 worth of risk, and the maximum profit at expiration is $8,300. So, and that's not to overinflate what's possible here, but it does kind of give you an idea that if your expectancy is very positive, you're not risking 8 to make 1, you're risking 1 to make 8. So that's really powerful. And let's take a look at the market. All right, so yesterday, obviously we had the big Fed news announcement, and we'll start with the daily. We'll start with the daily chart. It's a lot going on here, but overall, we're still under the 200 period moving average, still under the 50 period moving average, and we had this multi-day rally over the last few weeks, and we moved up about 11% from the lows and started breaking down after that. So right now, we're putting in lower lows over these last 4 days. This line here is the previous week high. This is the previous week low. And this morning, we're just now breaking below the previous week low, right? And so why I put on the broken wing butterfly today is because of the downward movement of the market. So we have some negative delta here and positive theta. We want to always be positive theta. We have negative delta, and we have some negative vega. So if the market comes back up and volatility goes down, we can benefit from from a reversal in vega or a decrease in vega. The VIX, I haven't looked at that one in a while. Let's look at the VIX. It should be moving up. Yeah, it's starting to creep up a little bit off the lows. And if we go to the 1 hour chart, we can see that overall volatility has been coming down, but we did pop up to the 26 level, and now it's starting looking like it's kind of reverting back to the downside, which again, that helps our strategy in that we are negative vega. So if VIX comes down further, that will cause an increase in the overall P&L. So this has been really working great. Show you some of the trades recently. Been putting on butter. So for the last month or so, I put on maybe about, this is going back to September, right? I put on about 7 butterflies, I believe, and I haven't had a loss. I will post the winners and losers on the butterfly. but I haven't seen a loser in quite some time. That's the other great thing about option trading, is that you can be very clear about what your my trade results are, right? So as opposed to swing trading, when you swing, say you caught a swing today, it's very difficult to measure exactly how much you're risking and keeping that consistent. As opposed to option trading, when you put that structure on, one of the beautiful things about it is you know exactly how much is at risk. And so when you take it off, you know exactly what your return on risk is. As opposed to swing trading, when you put it on and you're like, okay, well, where do I put this above the previous hour or the half hour? Do I put it above a 15-minute close? I mean, that risk changes. And so when you look back over, say, 100 trades or so, you don't really know what you're looking at. You don't really have a good data set. And what I found is that with this kind of trading, option trading, you have a clear-cut data set. Let me just give you a quick example here. All right, so the last butterfly we put on was on 10:25. Here's a butterfly, and we put on one contract, one spread at 3,900, and here are our prices. And overall, that was a 14.25 debit. Okay, now on 10/31, the same butterfly, the 3,900 butterfly, we closed that out at 16.15 credit. Okay, so basically a $200 profit here on 14.25 risk within a week. So that's, we put, that was like a 6-day trade, right? So 14.25 divided by 16.15, minus 1. All right, so that was an 11%, 12% return on risk capital in 7 days. And you're doing this roughly every 7 days is what, every 6 to 7 days is how much, is a typical time in trade, or days in trade. So, highlighting the butterfly here, in this kind of market is a beautiful thing. Your risk management is tight. You put on your alerts. So, for example, we're right here. If this thing comes down to 36.40, I have an alert at 36.40. I'm going to take it off. That would be I'm going to take it off for a profit. Depends on what the VIX is right there, but I'm going to take it off for a little profit, $67 on 15.85. What, that's 5% profit, and the market's going down. Okay. Not too many businesses allow you to work like that, to work like this, guys. So, if you want to learn some more of this, if you're interested in this kind of thing, and you're just getting started, or you're started and you want to learn about these strategies, just put a comment in the feedback, and I'll write you back. All right, have a good day.